All right, so we're going to go ahead and get started here. People are still filing in. Wish we could hand you, I guess, a virtual drink as you enter the door. We're going to get rolling here with our kickoff inaugural presentation. Centerline's been wanting to host some events like this. COVID has gotten in the way a bit, but we found ways to adapt with our wonderful Zoom platform. So thank you for joining us. My name is Andy Arnold. I am the CEO and Senior Wealth Advisor at Centerline. I also have with us Ben Doninger, our resident CFP and Wealth Advisor. And tonight we are going to be talking about some proposed economic plans and what they mean for you. We're going to be touching on several topics related to not just economic plans, but the markets. And we really hope to give you an overview of some of the things that we really see throughout the quarter. I am speaking into the sun coming directly in through my window here. So as I try to position myself out of that, we thought it would be helpful for you to see some of that data that we use in our quarterly reviews of portfolios, looking ahead at economic trends and some of the decision-making tools that we employ here. So let's talk about sort of the first quarter in the market, what's led us up to this point. We'll touch on that briefly. We also want to hit 7 key points related to the American Rescue Plan. There are additional policy proposals. I'm sure everybody's sick of hearing about infrastructure plans. That's all we hear about on the news lately, but that is important. That's going to affect the markets and all of us for some time to come. The American Families Plan, and then several proposed tax changes in order to help pay for some of these proposals. And that may very directly impact us all in one way or another. So the first topic here, the first quarter review. And this slide sort of says it all. Really, where we think we are is that getting COVID under control and behind us is going to be pretty essential for the economy to continue to engage, recover lost jobs, put Americans back to work, and propel GDP growth. And so a lot of data right here, just some things to point out. The US has had over 30 million cases. Something I didn't know, about 20% of those were caused by variants to the original coronavirus. That's something we're definitely keeping an eye on because that developments there could set us back. Worst case scenario would be rendering the vaccines less than useful. However, we think that's probably a lower probability outcome. There's a 98% chance that 200 million Americans are vaccinated by the second half of this year. And most experts agree we reach herd immunity at 60 to 70% of the population with antibodies. So you can see to the right there, this chart illustrates what happens when, or what has happened as people were infected in blue at the bottom, but then, vaccinations start to roll in and we have a combination of vaccinated, but previous infection, and then lastly, vaccinated only. So we do start to see us reach that herd immunity rate here by the end of the year. So in the first quarter, one of the big themes was that it seemed like as we're starting to come out of COVID and the news starts to get more positive, investors, large and small, seem to have a very big appetite for risk, or stated another way, no fear of risk. And so you saw that in some speculative corners of the market. Everybody's familiar now with the GameStop stock fiasco, where small investors really sent this thing way up, and yet you had some of the more sophisticated investors like hedge funds that got caught in there and sort of squeezed. So that's something we're going to talk a little bit about. The backdrop to that, though, this first quarter is that we saw a rise in interest rates after the Fed pinned those to pretty much all-time lows, or rates we hadn't seen since the Great Recession 10 years ago. Rates have jumped. The 10-year Treasury was about 0.62 a year ago, just over a year ago in the depths of the pandemic. It's up to about 1.6 today, and up since 0.9 at the start of this year. So a pretty rapid rise in interest rates, probably based on some fears around a potential rise in inflation and what the Fed may do later on. Investors this first quarter did shift money out of technology and growth stocks and into some more beaten down stocks. We call that a rotation to value stocks. And that probably is somewhat healthy as investors started to look at other areas of the market and just sort of the traditional big growth names that are were becoming expensive and more risk laden. And so, as I was alluding to in the last slide, smart money can also fail. These hedge funds that were shorting GameStop stock thought that it would just continue to go down forever, and a small group of bandit rebel investors decided not so fast and jumped into the market. So we did see that parabolic rise in that type of a small company, unjustifiably so. And so this always brings us back to our thoughts that jumping in on the latest market fad isn't really advisable. I mean, yeah, you could get lucky on something like that. If you bought GameStop at $12 a share and sold it at $400, you made an awful lot of money, but many people bought it at $300 and sold it at $200 and took a big loss. So those things aren't trading on fundamentals, they're trading on speculation, and that is a proposition that can get investors into trouble very quickly. And so, you know, it's just important to keep in mind that trends and fads can persist longer than you think. And, you know, an old saying that, you know, markets can remain irrational longer than many investors can stay solvent is something to keep in mind too. So if you can't stay liquid and ride it out, then you really shouldn't be messing around with fads and mania stocks. Looking at where earnings ended for the season, we did see a pretty substantial rise in earnings. So for the last quarter of 2020, earnings on the broader market were up almost 4%. And here, as we've ended the first quarter of earnings season, you know, over 20% rise in earnings is pretty amazing. Looking at that kind of continuing for the rest of the year, as you can see on this top line, what the S&P 500 did. Other sectors beneath that had varying degrees of success with their earnings quarter. So this is something we keep an eye on, and ultimately stock prices tend to follow earnings. So when you look at where projected earnings are headed here for the rest of this year, it paints a pretty positive backdrop for the stock market as a whole. However, there is a lot of risk in the market, and the weight of the top 10 stocks in the S&P 500 currently at over 27%. So that's higher than it's been, even all the way back to the dot-com boom in the late 90s and early 2000. So that's a bit troubling. And what that means is that the 10 biggest stocks in the market are taking up more than a quarter of the weight of the whole market. So they've gotten very large and very expensive. They are contributing a fair amount of earnings to the market. You can see in that second or the bottom half of the slide, 26.7% of the earnings attributable to those stocks. It has been higher, most notably during the Great Recession. Of course, stock prices were way down then. So looking at their earnings of those largest companies, they held up fairly well during the Great Recession. And then back to the dot-com and dot-com bust era, they also contributed more. A lot of data on this slide. I'm not going to make you look at every square, but the general theme, as I mentioned before, there's been a rotation out of, in the top right there, growth stocks towards value. So you can see on the right, top right corner there, the 3.9, negative 0.6, 4.9. We saw those decrease, and then under the value column there, 11.3, 13.1, 21.2, we saw a significant pickup in value. And this is, you know, back to this, the research that we do every quarter. We started identifying that small value stocks looked kind of beaten down and had lower PE ratios. They were cheaper than larger stocks. We started rotating the portfolio towards those small stocks, actually a couple of years ago, small value stocks. And of course, those have been very resilient and actually led the market here first quarter. And we were thinking back to 2000, 2001, 2002, stock market was down 50% during that period, but small value stocks actually were positive. So they gave us some confidence that that was a pretty good place to hide out a little bit here in the market. Looking at emerging markets versus developed markets. So you can see that the growth on emerging markets has been much higher than developed market growth. And we think this is attributable and will be for some time to come, because 84% of the world's millennials live in emerging markets. And so those markets are characterized by younger workers entering a workforce, working very hard, having a long trajectory ahead of them. Here in the US, in Europe, in Japan, we are rapidly aging society. So we are more in the mode of starting to retire, slow down. We're maybe a little less productive as we get older. So we have to think about, the relative growth rates of those economies and think about how to invest dollars that can potentially grow more. So this is some of the information that we look at when we think about how much money to allocate to emerging markets versus developed markets. So a lot of growth in emerging markets, but those can also be more volatile. So you don't want to allocate too much of your portfolio to that area. So it's definitely a balancing act that we think about all the time. And again, another confusing looking slide. So just to break this down a little bit, we're seeing a rotation to cyclical or maybe more value type oriented companies. And that can benefit markets outside the US. A lot of those companies are out there. Here in the US, we tend to have a lot of technology companies right now in this cycle of our economy. And we think that as money rotates kind of back into more of these cyclical sectors, that actually helps international investments. And so healthy exposure to international, we think, makes sense going forward for these reasons as well. Just another way to look at what we talked about. This is a 10-year run on what has happened to interest rates, the 10-year in blue and the 30-year in light green. So generally a slope from higher rates to lower rates over that period, but you can see what's happened over the last year as they bottomed out and begin to rise again. We do think that the Fed is going to be supportive, meaning keeping interest rates low. You can see at the bottom of this chart during the Great Recession, 2008 through 2015, the Fed kept interest rates very low, began to increase them again as the economy started to engage. And then what happened when COVID rolled in? They pegged interest rates to the floor again. And they're talking about keeping rates low for the next couple of years. We'll have to see as inflation worries mount. Just today, we got evidence of a whiff or a dose, I should say, of inflation. Not convinced that's necessarily a trend. We'll just have to see. There are a lot of things at play here. And so it's possible that that could tamp itself back down as some of the stimulus kind of works itself through the system and the Fed does keep rates low. But if inflation becomes a worry, no doubt they will raise rates again. Something else we tend to look at is forecasts for GDP growth around the world. And so to the far left on this slide, you see the world over 2020. The past year in blue was negative, obviously. The world lost about 3% growth. But then in 2021, it's expected to be close to 6%, and then it begins to slow down a little from there, still above trend line. The US, just to the right of that, you can see lost about 3.5% last year, but in 2021, it's projected to grow at over 6%. That's a tremendous amount of growth for the US. We typically have done 3 to 4%, and in the last 10 years, only between 2 and 3%. So we're a much larger but slower growing economy. And then you can see the Eurozone got hit harder, but is picking up growth. Japan, which is a country the world's third largest economy now, but again, older and slowing down, growth not as exciting the next few years. However, over in China, growth is expected actually, they didn't even slow down in 2020. They still had positive growth in 2020 and enormous growth, over 8% projected for this year, and dropping a bit, but still robust for the coming few years. So again, back to that argument for millennials and emerging markets, China is the largest of the emerging markets among many others. So now Ben is going to take over and talk about the 7 key points that you really need to think about in terms of the American Rescue Plan. So Ben, take it away here for a minute.
Yes, just like Andy said, we'll talk about the 7 key points. So the first part is on March 11th of 2021, President Biden signed in the American Rescue Plan. It's a $1.9 trillion stimulus package. It aims to help around 158 million households continue to get back on their feet after the pandemic took place last year. So the first things that this contains, is the $1,400 stimulus check to most Americans, which started arriving in mid-March. About 85% of people have received theirs by now. If for any reason you haven't received your stimulus, you can check that by going to the Get My Payment tool on the IRS's website. You'll also want to speak with your CPA or tax advisor to confirm you're in the adjusted gross income limits, as well as if you haven't already received the stimulus, your tax person may be able to help you determine if you should either file your 2020 taxes ASAP, if you should delay filing your taxes, if you're married, and if you should file jointly or separately, or other ways that they can help you receive that stimulus. The plan also extends the existing $300 weekly supplement for unemployment benefits until September. Most Americans would get that child tax credit, and it'll expand from $2,000 to $3,000 for children ages 6 to 17, and $3,600 for each child under the age of 6. The plan also temporarily increases the federal COBRA health insurance program's value from 85% to 100%. So if someone's lost their job, they should know that they have health insurance via COBRA, and it'll be available to them and their families at no cost through September. The new provision also provides 100% tax credit to employers to offset the cost of COBRA coverage for 3 months for any employees who are involuntarily unemployed. There's also increases in the premium assistance tax credit for anyone buying health insurance on the state exchanges this year. There's tax breaks too for student loan debt forgiveness. However, the debt must be forgiven between 2021 and 2025. This basically applies to a very small percentage of people, because the repayment plan they would need to be in is for 20 or 25 years worth of payments, meaning they would have had to start the repayment plan back in the late 90s or early 2000s to benefit from that. For 2021, more workers or without qualifying children will be able to claim the Earned Income Tax Credit. This plan also provides $28 billion in new grant program for restaurants and bars, payroll, and other expenses. And if you know anyone who needs a PPP loan, they need to file ASAP, because there is no extension of the PPP in the rescue plan. And so if they need it, that application is due by May 31st. Moving on to the next slide. So this is just kind of a big picture breakdown of where the funds are going. So some key points, just the stimulus payments and child tax credits worth $520 billion. State fiscal aids getting $350. Unemployment insurance is another $246, and other health and education grants. So in total, it's going to cost about 8.4% of GDP. There have also been some additional policy proposals, including the Infrastructure and Families Plan. So we want to touch on a few of these important points as well. The proposed infrastructure plan is a $2 trillion plan. Congress is likely to take up infrastructure as the existing 5-year plan expires this summer, and current spending likely undershoots needs. Although infrastructure has bipartisan support, the usual disagreements over where to invest and how to pay for it persist. A large infrastructure program will likely benefit commodity prices and sector-specific equities such as like industrials and materials, and also expect like additional focus on green infrastructure, including investments and tax incentives. This chart kind of highlights a bunch of the key areas where the proposed plan allocates the areas being funded. The major area is transportation at 621 billion. So think about like bridges, roads, public transit, airports. Manufacturing gets another 300 billion, and some of that's actually going to go to semiconductor manufacturing, which has actually become a huge issue and is something we even mentioned in our most recent quarterly rebalance letter. Other areas of importance include home care services, renovating and upgrading houses, schools, the VA, water infrastructure, etc. This program is going to cost potentially 10% of GDP. But that's not the only proposal. There's also been the American Families Plan, which was proposed on April 28th, and that'd be another 1.8 trillion. It deals with universal preschool for like 3 and 4-year-olds, 2 years of tuition-free community college, paid leave program for new parents, or permanent expanded child tax credit, as well as subsidized childcare for lower income families. Fiscal spending, so Goldman Sachs is anticipating Congress to spend all new revenue on infrastructure, climate, and social programs. And then for healthcare, there's been proposals to broaden the eligibility for health insurance premium subsidies under the Affordable Care Act and to make them more generous. Also, they proposed lowering Medicare eligibility to age 60. So when we add all these, plans up between the rescue plan, the jobs plan, the families plan, these additional proposals, it's about 6+ trillion in spending or tax cuts, which is obviously a very large and almost unfathomable number. But before we get into how we might be paying for that, let's first take a quick look at what the likelihood that this would pass and what it could do to the national debt. First, it's important to remember that these proposals are only proposals and will more than likely be some form of negotiation before anything is signed into law. With a 50-50 split in the Senate and a very narrow margin in the House, Democratic leaders will virtually need unanimous support from all Democrats in both chambers to pass any policy. This may constrain what Democrats can accomplish via reconciliation or legislation. Therefore, the policies that are originally proposed will more than likely not be what's ultimately signed into law. This chart is a great reminder that even though a lot of people fall under one political party name, those individuals range from extremists to moderates within their own party, and they may not agree with each other intra-party. So we fully expect some give and take from proposals as they go through reconciliation. It's also important to remember the differences between legislation, reconciliation, and executive orders. It'll be challenging to pass any ambitious or broad-based pieces of legislation, as it would require 60 votes without any reconciliation in the Senate. So therefore, all the Democrats and 10 Republicans would need to support the legislation for it to pass the Senate. So the proposed policies will more than likely go through reconciliation and negotiations will take place, which means the proposals will be moderated some. This chart offers an example of like potential policy changes as they would go through each style of implementation. And so another piece of the puzzle and kind of a backdrop for why all these policy proposals have been pitched this early is Democrats are, one, hoping to deliver on campaign promises, but also they're keeping the 2022 midterm elections in mind as well. So while there are these planned tax increases, this spending is more than likely to have an impact on the US national debt. The US debt to gross domestic product ratio will soon rise to the highest level in US history. The previous peak was back in World War II. The debt to GDP has long been like the benchmark for fiscal sustainability. For decades, conventional wisdom has said that high levels of federal debt creates a significant drag on the economy by diverting money that could be more productively used for business investment instead of buying government bonds. However, there are arguments that say that there are actually better ways to look at fiscal sustainability and the debt burden. And instead of looking at the overall debt, we should look at what the idea is. Policymakers should focus on the cost of servicing the debt as a percentage share to the next GDP. We can go to the next slide. The theory is that if economic growth rates exceed real interest rates charged on the debt to GDP will naturally shrink relative to the size of the economy. While debt levels are historically high, interest rates are also historically low. So the cost of servicing the debt is actually at a more normal level. Now, there are risks to this theory, and it can't go on forever, but as low rate, one of the risks is as low rates can create excessive leverage and limit the central bank's ability to respond in economic slowdowns. But it's probably fair to say most of us can agree the best way the government can reduce deficits is to adopt fiscal policies that encourage economic growth. The differences, though, fall between whether it should be businesses and tax cuts or government spending to support the economy as the answer. But next, Andy is going to take over and jump into how we're going to be paying for some of these policy proposals.
That's right. So who thinks all of this is free? I don't think anyone. So probably some pretty major tax changes. And so we're concerned with what that means for you, our clients, our friends, and what can we do to maybe mitigate it. First thing, we don't know, none of this is written in stone yet. So while we don't know, we can maybe guess what the future holds by peering into the past. And so our take is that the low tax rates we've experienced over the last several decades probably won't last. And if you look at the top half of this slide, you can see where our country's top marginal federal income tax rates have been. And during the World War II era, there on the left, we saw extremely high rates, marginal rates as high as 90%. Now, that doesn't mean you paid 90 cents of every dollar you earned. I believe there were 16 different brackets in there, but as you made more money, you paid an increasing share on that incremental dollar. So the average top marginal tax rate over all this period back to 1925 was about 57.5%. Well, right now that top rate is about just under 41%. So you can see a pretty big gap between the average and where we are now. And you can bet that politicians are going to want to try to close that gap to help pay for some of this. And then if you look at the bottom half, what you see is a different sort of look or a different way to look at taxes, but an effective tax rate. In other words, how much you pay in taxes divided by how much you earn. And so the top effective tax rate, right now is about 21.9, almost 22%, but the average all the way back to 1979 was almost 41%. So again, a way to maybe close some of that gap in here by raising those rates. You've heard a lot of talk probably about raising corporate tax rates. The Trump administration lowered them to 21%. And there's a lot of talk about moving them back to 28, although some Democrats have come out saying, well, maybe 26 sounds better. Again, I think this is kind of all over the board. And so individual taxes, the top marginal tax rate right now is 37. There's a lot of talk about moving that back to 39.6, where it was a few years ago. So a lot of detail here on this slide. I think what we want to try to hammer home here is that, yes, lots of proposals for a corporate tax hike, but you have to be careful. If you raise corporate rates too much here, then do companies move their headquarters offshore to another country to try to see? So there's a lot of talk about trying for the U.S. to work in cooperation with other countries to maybe set some kind of minimum so it's less advantageous for companies to try to switch countries like that. So maybe some kind of global minimum tax, and maybe that looks like it's 21, maybe it's higher. And then the point here, corporate inversion is what I was talking about, where it makes it much harder for US based, US domiciled companies to buy a company overseas and then kind of move its headquarters and do some fancy engineering that way. 10 changes for individual tax rates. So, that increase in the top income tax rate, generally they're saying $400,000. So that's a pretty big hurdle to hit, but it's unclear. Is that for individuals? Is it for families? And I think that just illustrates how unbaked these proposals are, at least right now. There's been a lot of talk lately, and something we've been concerned about, which is talk of eliminating the step up in basis at death. So under current tax law, you've maybe purchased a building or a portfolio of investments that have you paid a very low cost, you have low basis. Currently at the second spouse's death, when it passes down to the next generation, there's a step up in basis. So the next generation can literally sell those assets and pay little to no capital gains on it. Well, a lot of talk has been centered around just removing that completely. The good news, I guess, is that there is now talk in the proposal about, say, the first million of gains is exempt or does get that step up in basis. And then over that, you would see that come in. And that capital gains rate, which is, call it 20% now for certain taxpayers, could go as high as 39.6. So you're talking about a doubling of the capital gains rate. So, hopefully there's that preservation of at least that million in there, but we'll just have to see where that ends up. And then something else we've been watching closely for years is this idea about what happens if your wealth has expanded and you're looking at passing that to the next generation. So where we are today under current tax law, each individual has 11.58 million. So a couple can pass through over 23 million to the next generation before the federal government would impose an estate tax when the next generation inherits that wealth. There's a lot of talk about decreasing that to 3.5 million for individuals or 7 million for a married couple. 7 million is still a lot of money, but it's not nearly as much as 23. And we start to have concerns about, what happens to families, large families that have a lot of life insurance. And, you start to add retirement plans, life insurance, value of a home, other assets. Many families may get to that 7 million mark pretty quickly and face taxable estates. So paying very close attention to that. And then a proposal to maybe change how people get deductions for retirement plan contributions. Right now, if you're in a higher tax bracket, you put money away in your retirement plan, that money goes in pre-tax. So you, in fact, get that deduction. If you're in the 37% bracket, you're getting a 37% credit for those dollars going in. There's talk now to limit that to just 26% kind of across the board. So that could affect higher income earners as well. How you deduct or itemize your deductions may change for those higher income earners. So it may be limited to 28%. And where this could affect people is if they make very large charitable contributions, for example, or have a extreme amount in medical deductions. They may not be able to itemize the full extent of those deductions going forward. The earned income tax credit could be expanded for workers over 65. And I think what they're trying to do here, that tax credit generally applies for lower income workers. We usually think about that on the lower end of the scale, but since many Americans are now having to work past traditional retirement age, we think that tax credit could actually be useful for those sort of lower income earners that are above age 65. So that might actually help people who are struggling sort of later in life to prepare for retirement. And then a lot going on in point 8 about child tax credits and how to pay for child care. A lot to get into here. We can talk about that offline if anybody has specific questions about it. But again, sort of half-baked, and we don't really have all the details, but some push towards tax credits for child care and just credits for people having children. Certainly 5 years old and younger. The first time homebuyer credit may be restored. This is something we saw before. First time home buyers got a tax credit for $10,000. That's being expanded to $15,000. So a return of that could help people that are struggling with the expanding cost of owning a home. It's gotten a lot more expensive. In fact, we posted the other day that the average cost to build a home now has gone up to $36,000 in the last year just due to lumber costs. So this might be able to help first-time home buyers get into homes. And potentially some rules regarding how real estate can be exchanged back and forth. Under the IRS rule 1031, certain properties could be sold and those assets moved to another property without paying a capital gains tax. So that's under fire right now as well. So we'll have to see how that ends. So because of rising taxes, there are 8 kind of quick takeaways we have for this. And the first one is just to think about your annual what we call your capital gains budget, or if you have capital gains that you want to take this year and you can lock in the 23.8 maximum rate versus that going up to 40% or more, that may be a smart strategy. It's possible that number 2, increasing municipal bond holdings. Those are tax-free instruments. However, the yields are very low right now. We'll have to see what happens to yields and rates, but municipal bonds could become a bigger part of higher income earners' portfolios. We haven't heard a lot about variable annuities for a long time. They were a vehicle to help defer taxes a few decades ago when tax rates were higher. We may start to see those come back around again. There are pros and cons to annuities for sure, something to keep an eye on. If you have the ability to accelerate income from next year into this year, that may be a smart tactic, as you could lock in today's lower rates. And at the same time, if you have an asset to sell, you might consider an installment sale so that you can spread that sale out over multiple years and try not to exceed that $1 million capital gains threshold that they're talking about. Everyone who has a trust, especially if you have retirement assets to leave to minors or to leave to beneficiaries that maybe aren't so good with assets, really ought to have those plans looked at. There's language in older plans that conflicts with the new Secure Act. So that's a project that we're working on to help people kind of really think about what their plan says, and are there bits and pieces in there that might not really work too well with some of the new tax laws. We're also hearing a lot more in planning circles about using life insurance if you have illiquid assets, so a closely held business or real estate. So that may become a piece of the puzzle in future years. We already sort of talked about number 7, consider basis management. That would just be to maybe recognize some low basis gains this year rather than waiting for those rates to go up. If you're charitably inclined, there are a number of strategies. Qualified charitable distributions. You can give money directly from an IRA to a charity and not have to claim the income or try to get the deduction. So that applies if you're 70 and a half or older. There are other instruments like donor advised funds where you can contribute appreciated stock, cash, other securities, and get a tax deduction all in one year, and then spread those gifts out over future years. And many other estate planning techniques that are somewhat complicated, but may be helpful in thinking through this. So to sum up everything we've talked about here tonight in a relatively limited period of time, the takeaways, we think the base case is for the vaccines to get us to herd immunity and the economy to get back on track. We call that the reflation trade, meaning things kind of move back up. The 8 million jobs that are still missing, get healed, and that all helps the market with strong performance going forward. We've noticed since the start of this year, small stocks have had better returns all around, and value stocks, more beaten down shares, sort of resurging. And so that's been a great place to be here for this year. We're glad we're able to take advantage of that. Smart money can fail, and jumping into the latest fad, I can think back to, obviously internet stocks in the late 90s, but I think back to Beanie Babies, and people were trying to make their fortune buying Beanie Babies and trading those online. And, that didn't work out too well. And then people, jumped into energy in the early 2000s, and then Enron happened, and that fad didn't work out. And then people started jumping into real estate in 2007, and the great recession and financial crisis came along, and real estate plummeted. And so, these things always hover out there, and they seem attractive, but usually by the time you've heard about these fads, it's the easy money has already been made, and you end up just taking more risk than you bargained for. So that's why we don't, reach out to our clients and talk about, hey, here's this hot stock or this hot thing that you need to jump on. We just think that that's potentially a recipe for disaster. And don't get caught too much in the trap. And there's all these talking heads talking about, debt and, it's horrible for the country and all of that. And, everybody has a different opinion about it. Debt levels are historically high. I mean, yes, more debt in the long run is not a great thing, but the cost of servicing the debt right now is still fairly low. And so we do think that it's a problem in the long run, but if interest rates stay this low, it's probably somewhat manageable. And people ask me all the time, well, how do we get out of 30 trillion in debt and growing? And I mean, it's not a foregone conclusion that we do make the right decisions politically, but if GDP growth stays kind of higher than the growth in the deficit each year, then you begin to chip away at the debt over time. And to me, that's the most likely scenario. Now, that may not happen in any of our lifetimes, but that would be sort of the least painful path to take. We're just going to have to see what happens here, I think. The stimulus and vaccine program, as well as the infrastructure bill, we think does add a nice backdrop to the economy and the market. There's a lot of cash in the system, a lot of stimulus, jobs being created. Consumer confidence and spending is way up. Don't forget, our economy is 70% a consumer-based economy. So as long as consumers feel good about things, about the virus decreasing, vaccines being available, money in their pockets, if they spend that money, then that's a very strong backdrop to the economy. That translates into earnings for companies, and then stock prices are supported by increased earnings. JP Morgan in particular thinks inflation is in check over at least the next 2 years, and that means, again, that the Fed will keep rates fairly low. That's another strong positive to stocks. If bonds don't yield very much, then there's not much competition for stocks. And so we feel that's a strong backdrop as well. Goldman Sachs thinks that the S&P, is going to be strong here by the end of the year. And the last takeaway is that taxes do look like they're increasing. So, you should be talking to your CPA about that. What can you do? We're working in the background here to think about what to do, how to mitigate some of that potential damage. Our page of disclosures, we can email that to you if you'd like. We only have been, I think, 400 more slides this evening, and then an exam at the end to administer here online. So that concludes our presentation. We do have, it looks like, a few questions coming in. So let's just take a few of those. The first one, I'll try to summarize it here a little bit. Just looking at kind of the trajectory of the market, it's up. What do we see as the biggest risks to that? Is it that stock prices are already high? Is it that interest rates and inflation may begin to kind of step up here? Or is it something else we haven't even thought of, a kind of an unknown risk factor? Ben, what do you think about that?
Yeah, I definitely think that one of the bigger threats would be kind of this pent-up demand not ultimately being materialized. A lot of the reports that we're seeing is that come, second half of 2021, we're going to have all this demand from people that have been locked in their houses and they haven't been able to do trips. They haven't been able to do this, haven't been able to do that. And that there's just going to be this surge demand that's laying around out there that's ultimately going to be realized. So obviously one of the big threats is, what if those expectations don't come in that they're thinking, and maybe the demand isn't there to have these, and ultimately like the earnings expectations just aren't there, because as we talked about earlier, company valuations are ultimately followed by earnings. And so if the demand or the earnings ultimately aren't there, that could be a threat, as well as if there's any of these variants that end up, basically the vaccine being not effective against it, and we have to go back into lockdown mode. think that that would be
Fun.
another just big gut punch to the markets and society. So I think those are probably the two kind of big things, kind of more big picture that we could see as big threats to the market.
Yeah, I agree with you. You kind of stole my thoughts on the variance. That would be the one kind of really bad thing that could come in that we're not really expecting. That's certainly not priced into the markets right now. I don't think that that's super likely to happen, but it's obviously a possibility. Okay, do you want to take the next question?
Yes, it says basically, with bond rates so low, are bonds still like a good investment? I'd say big picture is yes, they're still a good investment. At the end of the day, they are about preserving your capital, and they are about having a diversification against equities. So typically, just as we saw a year ago, when the equity markets were getting beaten up, the S&P dropped, I think 34% from peak to trough from February to March. But the bond markets, guess what? The money was leaving the stock markets and going into the bonds. And so at the end of the day, people were moving towards those safer type investments. And at the end of the day, that's kind of what your bonds are truly for. They're for that, to preserve your capital and have that less volatility. So I definitely think bonds still hold, even though they may not be paying the best interest rates right now. I still think they are a good and important part in a portfolio.
So what I hear you saying is that, yeah, a diversified portfolio is key. Having some bonds in that is also a smart idea. Just because yields are low, you wouldn't want to sell off all your bonds and put it in the stock market hoping to get higher returns. You still want those bonds in there as a diversifier, as ballast. And the way I look at it, if you have bonds in the portfolio and the stock market does decline temporarily, you have a store of value to maybe take some of that cash and buy stocks when they're cheap again. So all around, I think a good idea as part of a well-balanced breakfast, right?
Absolutely.
Okay, and then this next question, all this talk about taxes and tax law changes, if I'm filing my taxes on Monday, does this affect me? Do I have to tear everything up and start over? Great question. No. 2020 is locked in. You have to file your taxes by Monday, but that is locked in. And yeah, all of these proposals, are talking about going forward. And our thought is that we're talking about 2022, not even 2021. I guess it's possible it could affect us in 2021, but I think that's much less likely. I think we're looking at a 2022 rollout for these tax law changes.
Agreed.
All right. Any other questions? Any other questions from the audience? We still have quite a few people here with us. So anything else? You can type your questions into, should have announced this early on, but into the Q&A section here in Zoom. I see a lot of attentive people, but no questions from the peanut gallery. So, all right, give it another second. No, well, you can always send us questions directly, and we're happy to answer those individually as well. I do not see anything else. So with that, we'd like to thank you all for attending tonight. We hope to do these a little more often in the future, maybe even quarterly, to give you a peek at what's going on kind of behind the curtain here at Centerline. So always welcome questions in between, and we hope to see you all on the next presentation. Thanks a lot. Have a good evening.
Night.